Ever think about guiding principles for an investment philosophy? Let's talk about it. Welcome to another episode of Millstone River Live, a podcast brought to you by Millstone River Wealth Management.
Hello, Matt.
Hello to you, Adam.
In the past, we've been talked a lot about on these podcasts and have been proponents of the power of personalized financial planning. We think it does a lot for helping our clients identify and prioritizing their goals. It can help them have a deep understanding of their household cash flow, which aids us in knowing their capacity to save. It sometimes lets them know how to smartly use that and how to avoid not being effective about how they borrow for major purchases. It helps evaluating ways to minimize taxes, manage your liquidity, and the timing of when you need cash are all powerful benefits of having a plan. But when all of that is done, then the next step is how do you effectively grow your money, your wealth, to accomplish all those goals? And that's where having a philosophy around investing is important. And I thought today maybe you could share what are some of the important tenets that you've built over your career that you think allows for successful investing.
Yeah, happy to do it. I think what happens is when markets are doing well, people see their account values rise. Nobody questions things too much, and that's fine. But when we see downturns or increased volatility in the markets, or people see their account values have dropped, that's when people start asking more difficult questions. And those people include us. We start asking ourselves, are we doing the right thing? Are we doing the best possible thing we are able to do? And I find that having, these 7 principles that I've sort of accumulated and stuck with for many years served as a little beacon during choppy water navigation. And so, yeah, happy to talk about it.
That's
and
great.
I think one other thing too is if it helps anybody with their own decision making, that's why we do these podcasts, is to share these little pearls that we've accumulated that we think are worth sharing.
Why don't we delve into them?
So I have 7, as I mentioned. They're in no particular order other than just how I've accumulated them over the years. And I would say probably the newest edition is more than 20 years old on my list, so nothing is brand new here. And probably nothing is earth-shatteringly revelating. It's really more about just good, solid guidance that will get you through tough times and good times alike. So my first one is focus on what you can control. Often we have a situation, whether it's a news headline, especially those that are more significant, or something else that's beyond our grasp, beyond our ability to manage, and it causes angst for people. And the following question is usually something along the lines of, what are we going to do about this? We can't control those things. What we can focus on is what we're doing within the portfolios. And keeping our eye on that is not always the easy thing or the natural feeling thing, but certainly I think most people would agree that that's what we need to do. And I would add one other point on that, which is focus on what you can control probably applies to more things than just investment portfolios. Probably applies to lots of decisions we have, whether it's our own health or raising children or buying a house. Every major decision that we'll make, it's very easy to get distracted by those things that are beyond our reach.
I think that's a great point, especially at the time of this recording in which geopolitical tensions are high. That's something we get a lot from clients, but I think it falls into what you just highlighted of just, make sure that your eyes are focused on the right place. And that generally is a great way to move forward. What's your second principle?
So not much of a departure from what you just said. Look beyond news headlines. I mean, you just mentioned that geopolitical tensions are especially high. As we're recording this podcast episode, we have two major wars going on planet Earth. We have a very choppy political climate as we are heading into a presidential election season for next year. We have kind of the after effects of the COVID pandemic and, how we sort of either go back to normal or go back to whatever the new normal will be. But people sometimes look at the news and try to extrapolate from that things that they should be doing in their investment portfolios. And I would maintain that while the news headlines creates a short-term distortion, probably just noise for a matter of days or maybe weeks, it almost never creates a trend. It almost never creates a new pattern that we should be addressing in investment decisions. Rather, it talks about what's going on in the world, not necessarily what's going on in the economy, and more specifically, not necessarily what's going on in the stock and bond markets, either here in the U.S. or abroad. And so I like to remind myself and I like to remind others that the news headlines really serve almost no purpose from an investment decision-making perspective.
What would you like to review next?
I think the next one is definitely difficult for me, which is maybe why it's on my list, is I think it's worthy of frequent reminders, self-reminders even, and that is managing emotions. The stock and bond market decisions that we make as far as how to invest money, when to make changes in allocations, or picking good companies to buy stock in or what have you, we should not use emotional criteria. Definitely easier said than done. And I am probably about the worst at allowing emotional criteria to infiltrate my otherwise good and logical thinking. But that's why it's on my list for my investment philosophies. I think we have to manage emotions in such a way that it doesn't taint an otherwise good decision or an otherwise logical process. Thinking about, we're upset because we don't like the outcome of a political election, or we don't like how a political campaign is being run, or we disagree with some so-called expert about whatever the topic du jour might be. It's easy to get emotional about these things. But then there's also the internal stuff going on in our lives. What's going on with ourselves, with our families, with our extended families, with our friends, office politics, and, everything else that we contend with on a day-to-day basis does create an emotional sort of pitfall that we might find ourselves trapped by, and then the resulting decisions are almost never as good. So I think, my third point here is definitely it's important to manage our emotions in such a way that, yes, we are emotional creatures, and yes, we will always be influenced by those emotions, but we should kind of draw the line at, does that then create a negative outcome in our decision making? Again, I would say about investment portfolios and otherwise.
Yeah, there's been an entire academic school of thought that's built around understanding how emotions affect investing. So it's not just individuals, it's professional traders, investment management firms spend many efforts to try to ensure that whoever their traders are in the right set of mind when they're making investment decisions.
Yeah. And one other thing I would add too, not to cut you off, is just that it's obvious that even people who think that they're unemotional allow sometimes, against our better judgment, will allow those emotions to creep into how we're making those decisions. And the key is to just somehow try to figure out how to parse that.
So maybe you can give an example when you do let your emotions get out of control. What are sometimes mistakes that can occur? I think that will lead us to your next tenet.
Yeah, so the next one on my list here is to avoid market timing. And I think it's easy when emotional decision-making gets in the way because we want to try to figure out what's going on. How many times does somebody look at a chart of any index or a particular stock, for example, and they think that they can predict what the next move is going to be based on the direction of that line on the chart? Nonsense. Can't do it. If it could be done, it would have been done already. In other words, people would have figured it out by now. And with all of the computer power that we have and the ability to identify the trends or patterns and try to replicate those things, it is very much like predicting the weather. When all of these conditions line up in the same way, we tend to get this outcome. But it's tend to get, not always get. And sometimes that percentage of tend to get is not even the majority of cases. Sometimes people will tell me, let's reduce our exposure to the stock market. Things are too choppy right now. We'll come back when things are better. Well, how do you know when that's going to be? The short answer is you don't. No one does. The longer answer is, even though we think we might be able to identify when a new pattern is emerging, by the time we've identified it, it's happened. And the data tells us in quite compelling ways that by the time a new trend has emerged, the most significant portion of that trend is now in our rearview mirror. We missed it. So when somebody watches their portfolio drop in value because of whatever the current market conditions are, and then they say, well, let's sell out of this stuff. Let's go into cash, or let's go into bonds, or go into stable value funds, or whatever the safety designation is going to be. And then when things get better, we'll come back. But we know that when things get better, they get better quickly and without warning. And so by the time that you go back, you've now ridden it down and missed a good chunk of the ride back up. You made 2 consecutive poor choices. And so we say that market timing is a fool's errand. You can't do it. No one has been able to figure it out. Even the most successful investors of all time have come out and said it's not about market timing. And so what I would say is that's the reason it's on my list as the 4th investment philosophy that I try to stick by.
I believe it's Howard Marks that has the line who says, if there are people that are so successful at market timing, where are they? Because I know most of the billionaires in the world, and I haven't met any that got there because of market timing.
That's right. And that's my point that I try to make with people, not in a rude way or a condescending way, but it's just to say, like, if it was so easy to do this market timing thing, we'd all be doing it. And we wouldn't have to worry about anything else. We would just look at a chart and figure out what the next move is going to be. Sometimes the image that people understand is when you think of a movie like Back to the Future, when he had that sports almanac and he was able to see all the scores from baseball games that happened decades ago. That is probably the only way to do this successfully. And people will say all the woulda, coulda, shoulda type decisions. What would I have had to see to go back in time and buy more Apple stock or more Amazon stock or whatever it might be? And we can all find those kinds of examples, but it's impossible to do that in reality. So instead, let's focus on, time-tested fundamentals and make that the basis for good decisions, not this market timing.
Well, what is a relatively easy thing that you can implement that will help your outcomes?
So I'm going to say this word. Everyone has heard it 1 billion times, and the fact that you've heard it so many times does not make it any less important. And that word is diversification. I mean, one of the fundamentals that you can stick with and know it will help you achieve a lot of your investment and financial goals is to be diversified. And what does that mean? It does not mean to buy 3 funds that invest in the same way. That's not diversification. When we say it, what we're talking about is giving yourself exposure to different types of investment securities, different types of asset classes, different types of industry sectors, different geographies, making certain that we have built these things in such a way that we're not too concentrated in any of them, and we're also not so lightly exposed that there's no impact of having that diversification. Finding a good balance of sorts between one asset class and another, or between one industry sector and another. When large company stocks tend to do well, it is true that small company stocks don't always do as well, or sometimes they do much better. So what's the key? The key is having exposure to both. Large company stocks tend to behave more like other large company stocks than anything else. U.S. Treasury bonds tend to behave like other U.S. Treasury bonds more than they do like anything else. And so what we know is having exposures in these different types of investments and maintaining that diversification is not a guarantee of any kind of an outcome, of course, but it is a surefire way to make sure that you will minimize the downturn impact and you will enhance your potential for upturns when market conditions allow.
When building portfolios, what's something that you try to avoid doing?
So what I would say is I avoid chasing past performance. That's another one of my investment philosophy points. One of the clearest ways I see people violating this principle is, when someone looks at past performance from a few different mutual funds, for example, the best place I see this, or the clearest place I should say that I see this, is like in a 401k enrollment meeting. You give everybody who works for the company a list of all the investment options that are available to them within their retirement plan. And if they're going to pick their own funds, what I observe quite frequently is that people will look at one thing on each of these funds, and that is, how did they perform last year, the year before, and so on. And based on those numbers, they'll pick the ones with the greatest performance percentages, and that's how they invest. There's a few problems with that. Number one is, just because they did X percent last year doesn't mean that they'll do that same percent this year or next year or any subsequent year. Secondly is that there's other criteria to each of these investment options that kind of dictates why they're there. Why are they on the menu for consideration? It's not based on the performance. If you say, well, I want to pick all of the best performing funds available to me, I get that, but what you're doing is you're avoiding the real decision making, which is, what do these funds invest in? How do we make sure we're diversified? How do we make sure that we're focusing on things that are most important for our goals, for our investor profile, for our risk tolerance, for our time horizon, all of those factors and more. And just looking at past performance is a mistake. Kind of like trying to time the markets. Using past performance as a guide, whether it's the sole guide or the primary guide for making selection about investments, will get you absolutely nowhere except disappointed. So what I try to remind people of is, if you have a fund that had a great history over a long number of years, that's a good sign. That long history over a great number of years is a better indicator of what you might expect in the future. That makes a few assumptions, though. The assumptions are that the same management process is in place. Maybe even the same managers, the same personnel are all in place. Maybe they haven't changed anything about those aspects of how that fund is run or that investment is managed. And if those things are intact, then yes, a long history of performance is one more data point that you could consider. But it shouldn't come first in the priority list, and it definitely shouldn't come exclusively.
I agree. So I think that was 6. What is your 7th?
So this is the one that is most difficult for me to try to convey. And I think for some people, not all, not even the majority, but for some people to understand and internalize. And that is, when the fundamentals of your investments remain strong, despite what market conditions might be all about. But when the fundamentals of your investments remain strong, stay the course. People panic when they see something going on. We saw this most recently with the COVID pandemic, and people were very nervous. Understandably so. We had no idea what we were heading into. If you can rewind your mental clock to the winter of 2020, if you were asked what was coming, I don't think most of us really knew, at least not with any degree of confidence. We tried to read the tea leaves and figure out what was going on. We looked at history as a guide, but in reality, we were sort of looking into a dark corridor. And so it's easy to understand why people would panic in that circumstance. We had it 15 years ago with the financial crisis, the mortgage markets and interest rates and those factors that sort of led to this falling down of a house of cards kind of a thing. And it led to a significant recession in our economy and most economies around the world. And, of course, it had great impact on all kinds of investments. Almost nothing was spared from that downturn. And if you go back in history, you'll find many examples of this. However, when you look at data that's been compiled with the benefit of hindsight, which is always better data to use because looking back in time, having that bright light to illuminate the things that we might have missed along the way, gives us the ability to learn from that. And one of the things that we learn is that the investment portfolios that remained on track, despite how painful it might have felt, despite what we thought we were heading into, the ones where they had a sound process in place, they had fundamentally appropriate holdings in that portfolio, that led to much better outcomes for those people than the ones who panicked and made knee-jerk decisions or just didn't stay on track. One more thing I'll add to that is when you build a thoughtfully constructed investment portfolio, as we try to do here, and it considers and is informed by a client's individual goals, the things that are most important to them, the objectives that we are seeking to accomplish with that portfolio. The worst thing you can do is get off track because something comes up. We know from history that market downturns will occur again. We don't always know when they will be. We don't know what the cause will be, but we know that they will be. And knowing that they will be, those negative numbers are always baked into our long-term assumptions. So we know that you're going to experience negative returns sometimes. Fortunately, the stock market and the bond market is in positive territory more often than it's in negative territory. We know that's the case historically. So staying the course means that we will get through a downturn and will resume a more favorable trajectory. And having missed out on that turnaround is much more costly, by far, not even close, much more costly than trying to do any of the things we've talked about, like market timing, like chasing past performance, like letting emotions get the better of us, like letting news headlines kind of drive our decision-making or thinking that what we see on cable television is going to somehow shift the economy and the investment markets as a result, because we know that, generally speaking, except for short-term noise, those things do not have impact. So focusing on what you can control, looking beyond those news headlines, managing emotions in an appropriate way and not letting them taint otherwise good decision-making, avoiding the timing of markets because it's a fool's errand, remaining diversified in the investment selections that are made, avoid chasing these past returns thinking that that will dictate all of the future returns, and staying the course when you're in a well-constructed portfolio with strong fundamentals. That's my investment philosophy. And if I can, I'll just add one more thing, and that is this is not meant to be the be-all, end-all of investment decision-making. Instead, what I'm sharing with you is these are some of the principles that I stick with and remind myself of frequently, especially during the more difficult and more challenging times. And I try to share that with clients who might have questions, just to say these are the things that have done a better job of informing good decision-making historically than virtually anything else. And so these are the things I choose to kind of stick with and allow them to guide and inform future decisions too.
Well, Matt, thank you for sharing that. I hope the peek behind the curtain of what guides your investment philosophy in combination with rigorous financial planning process is what allows us to hopefully help our clients get where they want to go.
Well said. Thanks for listening. We hope you've enjoyed this episode of Millstone River Live. Feel free to share it with someone you think might benefit. Millstone River Wealth Management is an independent wealth management firm based in New Jersey. We form a supportive partnership with our clients and help with financial education and planning. We welcome your feedback. Send comments or questions to podcast@millstone-river.com. More information about our firm can be found online at millstone-river.com. Thanks for listening.